Welcome to This Week in Money. I'm Jim Goddard. Today, CIBC Wood Gundy's Ross Clark on the North American markets getting over Brexit shock. Raymond James's Garth Turner warns us about the risk of the real estate bubble in BC and Toronto. Zeal LLC CEO Adam Hamilton explores the growth potential of silver. We'll talk to Ross Clark right after this.
GEM International is a new diamond explorer in the richest diamond producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. GEM International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark, an investment advisor at CIBC Wood Gundy in Vancouver. Welcome back to This Week in Money, Ross.
Always nice to be with you, Jim.
How are the equity markets looking 2 weeks outside of the Brexit vote?
Well, you would, at this point, question whether there had been anything of significance as far as the North American markets are concerned. For Europe, it's a little different. They clearly have stayed under pressure, but if anything, the flight of cash towards North America has really benefited the Toronto and the New York markets. The S&P closed the week just within a hair here of its all-time high, so this is taking out that good rally we had in May, the one that we had back in November, and you're all the way now looking back to May of last year. So kind of fitting into the model of a presidential election year that we were hoping for, other than the spike down on the Friday and Monday following the Brexit vote. Prices have been pretty much on track here just to work their way higher. Without a doubt, there's been good liquidity available out there. The interest rates have continued down. You saw strength in the bond market, short-term rates down, and it's pretty much put a fire under just about everything right now.
How is this affecting things like oil?
Yes, the oil market closed off the week down 45.5 in terms of the price. Getting very close right now. We've been talking about a 100-day moving average to be the support area, and that's been creeping up underneath us. Right now, it's in the low to mid $44 range. So, wouldn't be at all surprised that we're looking at an interim low in the oil, and from the high that we put in at the $52 level, it's been about the right length of time for this correction to run its course. If you look at the other big bear markets, the last 5 or 6 of them in oil, that first 90 days to plus or minus have had a good run, and then a correction like we've seen just now. And from here, you look for some stability and look for the stocks in the complex to do pretty well from here.
Of course, we did have a slight glitch in the system with the Fort McMurray fires. The interior of BC saw some service stations shut down, but it looks like we've bounced back from that quite well.
Oh, yeah. And you're starting to see actually inventories popped up a little bit this week, but the key here is going to be what's the demand side of the equation, and with all the shut-ins that have happened in the last year or so, I'm expecting that you're going to see reasonably buoyant markets as we move forward. I think you've got, in the big picture, you've probably got a $26 to $30 major floor. You've got a $60 ceiling on it. And in the interim, I think you're probably more in this $45 to $55 type of range as we move through the next few months. And depending upon what kind of a winter we've got coming up here, with La Nina having an impact, I wouldn't be at all surprised that the nat gas price, which has been moving up off the bottom, might, after a bit of a pause here, have a pretty good run this fall.
What's gold doing?
Well, gold had a really good week 2 weeks ago when it managed to hold after the Brexit announcement. And at this point, we closed marginally higher on the week, 1365. And as long as we can hold the 13.15, 13.20 range right now, it for us measures up into the low 14s. 14 and a quarter looks like it's a pretty reasonable target area. And this is matching very much the style as we came off the 1982 bottom and the 1993 bottom in gold. What we'll be watching for in the coming weeks is to see if the stocks start to underperform the bullion, which they haven't done as of yet. They're doing very, very well. But you'll be wanting to keep an eye out for any possible divergences with underperformance there as your first clue that we might be ready for a deep correction. For now, I think mild corrections are what at the most you should be looking for in the next couple of weeks.
Ross, thank you so much for chatting with us.
Always nice to be with you, Jim.
My guest has been Ross Clark, investment advisor at CIBC Wood Gundy in Vancouver. If you have any questions for Ross, you can email him at ross.clark@cibc.ca. Coming up next, Garth Turner on This Week in Money.
Always consult your investment professional before making any investment decision.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Garth Turner. He's an investment advisor with Raymond James. He's a former National Revenue Minister, and he has the hugely popular blog greaterfool.ca. He's speaking to us from Toronto. Garth, welcome back to This Week in Money.
Hi, Jim. Pleasure to be with you.
The BC government just releasing stats saying only 3% of BC real estate is being bought by foreign nationals. But this was a very small sample taken over 3 weeks in June, and it did not include the last day of the month, which is quite often the busiest day of the month. Are these realistic numbers?
Well, I guess we'll know over time when we get more data. I mean, it's a small sample, and it may be reflective of it. It may not. I guess we just don't know. But I will say this, that the percentages of foreign buyers, 3% across all of the province, roughly 5% in Vancouver, is, Jim, I got to tell you, it's absolutely consistent with all of the other data that exists. We've had surveys of realtors in Vancouver, and it's done on a monthly basis. They're asked internally where their buyers came from. The BC Real Estate Association has collected similar data. The Victoria Real Estate Board does an annual survey on this, and the provincial government has also done its own estimation. Every single one of those data points, which have been refuted by people who want to believe foreigners are buying up Vancouver, has come to the same conclusion, and their number has been somewhere around 5%. So this is another data point, and it's absolutely the same data point. So I guess you can disbelieve it if you want, but I don't know when we're ever going to start seeing data that suggests something else. Yeah, there's a lot of people who are of Asian extraction running around Vancouver, and of course it's got a giant population of these folks, but it doesn't mean they're all Chinese nationals. And I continue to make the argument that Vancouver and the Lower Mainland is plagued with speculation and rampant real estate horniness that I think is really at the foundation of this. Borrowing is off the chart, and price appreciation is insane. So I think it's convenient to blame this on somebody else, but when all the data points to date, maybe we'll see more, but to date they all say 95% of transactions are local to local. You got to make you wonder, Jim.
What about these people who are so panicked to buy real estate they're foregoing home inspections? Something like 75% of the sales in the past year did not get inspected.
I think they're idiots. what else can you say? You want to buy a home, take a home inspector along with you. You can, 20 minutes, 30 minutes, you can get sort of a basic view into a home, and usually there's time to at least do that. People who buy without any conditions, whether it's on financing and they're not quite sure they can get it, they haven't been pre-approved, or it's no home inspection, I think they're rolling the dice without a doubt. And you're going to see more heartache down the road. Once price appreciation stops, so right now prices have gone up so fast, it's papered over all these mistakes people have made. But once that stops and the market stabilizes, starts to decline, which I think it will, and we can talk about that in a moment, I think there's going to be a lot of regret that people bought really quickly without having done their homework. I just wouldn't recommend it to anybody. If you need to get in a bidding war with no home inspection and no conditions, you're better off not even to be in that war.
The supervisor for financial institutions warns Canadian banks are being loosey-goosey when it comes to mortgage money. Do you agree?
Yeah, I do. And I think that's part of the problem. Once again, going back to the first point of this conversation, I think we can blame regulators and lenders and the Central Bank of Canada much more than we can blame offshore buyers for the pickle we've gotten ourselves into with the real estate market, with this bubble that is going to end badly and is already starting to end badly. So the regulator is pointing out the obvious right now. Lenders have been far too lax in what they've been doing. They haven't verified income appropriately. They haven't paid enough attention to debt service ratios of borrowers. They haven't looked closely enough at the quality of income of the borrowers, especially borrowers who say, I'm getting money from a rental suite in the basement, and that's going to help me afford this giant mortgage. They haven't looked at all of those fundamentals. In other words, they've been taking too much risk. Now, CMHC, Canada Mortgage and Housing, stands behind the banks for high-ratio mortgages for under $1 million properties. So that's made the bankers lax under $1 million, but over $1 million, which accounts for 90% of all the properties in Vancouver, it is simply lenders who are not being careful enough. So the regulator is making that point very clearly. I'm glad that they're doing it, but we need to have the province follow suit because it's not just the big 6 banks that are regulated by the federal government. It's also outfits like Van City, which are regulated by the province, and I think actually are more egregious in their lending practices than the big guys.
Well, they just had the review of real estate regulations. Now the real estate industry is looked after by a provincial supervisor instead of being self-regulating. Are these moves enough, and are they just too late?
I don't think they're going to make much difference to the market. That's for sure, because it's not, criminal activity on the part of realtors that has caused this market to develop. It's speculation, and it's cheap money. And it's what we just talked about. It's about lax lending practices. So people have been able to borrow far too much and jump into the market and spend all kinds of money they should never have been given. That's the reason why the market's crazy. So yeah, there's some shadow flipping, and the Globe and Mail made big headlines by talking about shadow flipping and assignment clauses. And sure, there was a little bit of that going on, but definitely not enough to affect the market. This is one of those simple, cheap political moves that Christy Clark can take in order to look like she is doing something actually proactive in the market. Lots of realtors I know are just flabbergasted, outraged that this is happening. They're now going to have some bureaucrats who have really no market feel in charge of the industry. I'm not sure that's a step in the right direction, but we'll see. But at the end of the day, is this going to bring prices down? Not a chance.
On Greater Fool, you described a likely hard landing in the Vancouver real estate market as a splintered tail fin and body parts in a smoky hole. What do you see ahead for Vancouver and BC real estate in general?
Yeah. Well, it's my usual, my usual tempered prose there. Actually, I thought a year ago, Jim, that we could come out of this with a soft landing. And that is that the market would sort of lose steam over a few months. sputter along, no price increases for a year or two. And, of course, that would be bad enough for everybody who borrowed money on speculation. But I don't think that's going to happen anymore. I think the recent speculative frenzy that drove prices up 30% in May, which was just insane, is the precursor of what I described in my blog, a hard landing with a big, giant, smoking tail fin coming out of a giant hole. So I don't think this is going to be great at all. Now, since I wrote that, we have stats that are supporting this. Sales have gone down significantly over the last period of time. Overall, in the market, we've got about a 7.7% overall decline year over year in May. But when you take a look at detached homes, this is not happy situation. Detached home sales year over year are down 30% in Burnaby, 28% in Richmond, 26% in the east end of the city, 35% in the west end, Whistler 40%. This is not good. You've got prices snaking higher at an insane pace, and you've got sales going down. If this was a stock on the stock market, you would see valuations going up exponentially on thinning trade. And any experienced investor would see that as a giant warning sign and get the heck out. They would short that stock. They would sell it. They would be gone. So this is the problem with residential real estate. People buy it for emotional reasons. They see prices going up. They only look at prices. They don't look at the other data. And they say, oh, my God, prices are going up so fast. We better get in, sweetie, before we're going to be priced out forever. So you get unsophisticated investors jumping into the market, continuing to be in bidding wars, and forcing prices up. Detached home sales are going down. Condo sales are not. So where's the smart money going out of? Detached homes. Where's the dumb money going? It's going into condos. So, Jim, this is not a great combination right now. To me, it is the precursor of some pretty serious issues down the road.
You're listening to This Week in Money. I'm Jim Goddard. We're speaking with Garth Turner, editor of the popular blog greaterfool.ca. He's an investment advisor with Raymond James. If prices in Vancouver went up 40% in the past year and in Toronto 30%, could you see them fall that fast, that hard?
Oh, yeah, absolutely that's possible. When real estate switch is turned off, the phones go dead in the realtor offices almost overnight. That definitely has happened. And people start questioning the decisions they've made. So a lot of people all of a sudden say, oh, geez, maybe I better get out of this thing, before prices go down. So you have listings that mushroom, and that can happen in the space of just a few days. So the more listings that go up, all of a sudden buyers say, oh, gee, look at all the selection that just happened. I can shop around. I don't need to get into a bidding war. So immediately we see a cooling effect starting to take place. I just don't know if things are going to go up or down 30 or 40% in a year. But, if they can go up 40% in a few years, they can go down. And remember that, a 30 or 40% decline in overall prices will wipe out many years of price gains. You can get a property that goes from $1 million to $1.3 million for a 30% gain. If it goes down 30%, it's going down a lot harder than that. It's going to take it down far below the gain of the previous 12 months. So this is something mathematically people don't quite understand. So when prices in the United States fell by 32% on average in 2005, 2006, it took prices, peeled them back to about an 8 to 10 year level prior to that. I don't think people understand just how impactful this could be or how close I think it is at the moment.
Some have suggested to me that August could actually be the turning point, really, where prices will have a downward trend.
Could well be. I think the numbers are showing us that. The sales declines that I referenced a few minutes ago are dramatic. They're definitely in the marketplace now. There's anecdotal evidence as well that sales are slowing, activity is slowing down, people are getting a little more scared of real estate. This whole is it a bubble type media we're seeing appearing more and more often. And of course, once it gets onto the front page, it's already happened. And when that transpires, then you're going to get an acceleration in the downward trend. I wouldn't be surprised. I think August, it could happen later in the fall. Let's not suggest this is, going to crash overnight. I'm not sure it will crash in the sense that people expect in a few months the lights have gone out. But I think over the course of a number of months or year, you could see a very substantial decline in pricing. And anyone who bought into this market with 5, 10, 15% down could end up underwater. No problem with that at all.
Are the Okanagan and Vancouver Island real estate markets vulnerable to changes in the Vancouver market?
Yeah, they are. Actually, you've seen this ripple out from 604 from the heartland in Vancouver. It's gone across the island. Victoria's got a little mini boom going on now. Kelowna's same thing, right out to like Langley. And so you've got this happening in a broad space right now. Typically, the suburbs get impacted after in the urban area, but they also get smoked faster. So once we start to see the decline in the city, you are going to see it really happening rapidly in the outlying areas, because there just isn't a reason why people are going to pay $800,000 for a house in Maple Ridge when prices are falling in central Vancouver, because people would rather live in the city than they would in Maple Ridge. They only moved out there because it was cheaper and more affordable. So when it gets less costly in the urban area, you're going to see that money being sucked right back in. So I think there's an elevated level of risk the further out you go from the city center.
If the real estate market collapses, are people going to remember the names of the people in the government at the time of it and blame them for the loss?
Well, I think so. And I think that's part of the reason you got Christy Clark doing what she's doing right now. That's one reason they moved in on this shadow flipping and realtors and took away the ability of that industry to govern itself. It's one reason why they started collecting this foreign buyer data. They want to look proactive. She even put out a little video the other day, or, here's 4 things we're going to do. And stuck it on YouTube and sent it all over the place. So they're definitely scrambling right now because I think they know this is the Achilles heel. When this all hits the fan, when the value of people's homes go down, in Vancouver, where people have shoveled the bulk of their net worth into one asset and drained off all their liquid assets and stopped saving for their retirement because everyone's gambling on one asset, these guys can have a huge political fallout, and they know it.
Did Japan's real estate market collapse during a period of low interest rates?
Well, it did to an extent. It certainly went to tremendous highs in the 80s, of course, and then started to come down in a continuous move. Interest rates went down along with real estate in Japan because the central bank was trying to mitigate the slide in the economy caused by real estate, but it didn't work. So now Japan's ended up with residential real estate values that are still about 80% lower than they were at the peak, and yet they've got negative government bonds. And a few days ago, government of Japan 10-year bonds were trading at negative 0.24%. So in other words, you'd be giving your money to the government, and in return they give you a negative return for 10 years. What a deal that is, eh? So it just hasn't worked in Japan. And I'm not sure it's going to work here either. So interest rates are quite low in Canada. Our bond yields now, Canada 10-year bond has fallen below 1%, and we still have this accelerating problem. I don't think central banks have been able to solve this too well right now, and lower rates at a certain point just stop working. I think we're pretty close to that here.
In the UK, 7 real estate financing funds or financial funds now are refusing to pay out any money. I thought at one time people called London real estate bulletproof. And are there signs Vancouver could be headed for a Florida, Arizona, or Nevada style crash circa 2008? Same kind of thing.
Yeah, interesting. Well, Brexit was a disaster. I certainly argued that on my blog vociferously against everyone who seemed to be arguing the other side. But I said this is a disaster. It's just going to be an economic suicide. And it is. I mean, the pound's at a 31-year low. Markets have gone down, and unemployment is definitely going to spike. Britain's probably going into recession because of this. And, this is an early warning sign. You've got all these giant property trusts, these funds, that so many people want to get the hell out of them, that the redemptions have overwhelmed the cash that these funds have on hand. Meanwhile, the real estate they own has become more illiquid because the market is seizing up. So they can't cash in on this real estate to pay the investors who want their cash back. So that's why they shut the door. And they've locked down the funds, so poor investors not only are seeing the value of their assets go down, they can't get out. Well, not a good situation. But that's one real downside of real estate. It's great when it's going up and everybody wants it in a bidding war, but when the market goes down, it becomes illiquid. You cannot sell it. Unlike a stock or a mutual fund or an ETF, you can click a mouse and get rid of that sucker in 1 minute, or actually 1 second. But with real estate, it can take you a year or two to get out of it. That's a lesson a lot of people will learn. So back to your question, could what happened in Arizona or Florida or California take place in the lower mainland? Yeah, of course it could. Real estate could get illiquid. The greatest real estate risk in the entire country is in the lower mainland right now because prices have shot up the most. Family incomes are not risen to support the fundamentals of the market, and therefore there's the greatest amount of risk. I can't tell you what's going to happen, but if I owned real estate in that market and I had seen these kind of gains and I didn't sell now, I would need my head examined.
Is a housing bubble a symptom of an out-of-control debt bubble in Canada?
Sure it is. As I said a minute ago, incomes do not support prices. So it's debt that is supporting these prices. And it's not Chinese guys either. I mean, forget that. That's a small part of the market. So it's debt. It's debt that is supporting all these transactions that are happening. And that's where we come back to the conversation we just had about the regulator. And the regulator has been far too lax, up to date on policing the banking lending industry. So we do have a debt bubble. We're at historic highs right now. 165% of family disposable income is represented by debt. In Toronto, for example, 40% of all the buyers of million-dollar homes have 450% debt-to-income ratio, and it's about 35% in Vancouver. These are numbers that are keeping regulators and central bankers up at night, and they should be.
Garth, as a former National Revenue Minister, Canadians and debt, how bad is it in your point of view?
I think we're almost at the point of no return. Debt is accumulated so rapidly that it's really going to be hard for interest rates to normalize now because the Bank of Canada needs to take interest rates up in order to curtail asset bubbles. But when they take interest rates up, we have this giant debt bubble here, which means debt servicing costs will be far greater for the entire population. They're going to spend less money at Best Buy and at the mall, and therefore you're going to see less economic activity. It's almost this vicious circle that's been created by central bankers now. I think it's going to mean low growth in Canada, especially as we have energy prices and oil prices remain low, commodity prices are depressed, economic activity is low. I do think the Canadian economy is in for a tough ride for a few years. As an investment advisor, it's why we have 2/3 of our clients' growth assets invested outside of Canada. We only have about 17% of their entire growth assets in Canada, and they're broadly diversified. So I just feel sorry for people who have bought all these Canadian mutual funds to get 70-80% exposure to Canada. I just don't think they're going to be happy campers at all.
We're hearing of U.S. hedge funds looking to short Canadian real estate. Are there any vehicles available to directly short Canadian real estate?
No, not really. These guys are blowing smoke. It's basically just a media play. There's a couple of companies around, a couple of mortgage originators that, are probably ripe for the plucking, but they're not big players. So there's no real easy way to short the market the way there was in the United States, where you had so much debt that was collateralized and people could make moves against it. In Canada, it's different. So I think it's just a pipe dream right now. I think it's just a bunch of guys, Americans looking to get easy headlines, and they're certainly getting them from people who don't quite understand the market here. So anyone looking to short the market, you got two ways of doing it: sell your house or rent.
Garth, is there a way for people to get a hold of you and find out more about both Raymond James and your blog, greaterfool.ca?
Sure. Well, greaterfool.ca, if you want to pop over there sometime, have a look at it. I publish 6 days a week, kind of things we've been talking about today, Jim. So there's a lot of information there on a fresh basis. Plus, I have a whole bunch of crazy people who make comments every day, so they're kind of entertaining. And certainly, if you want a little bit more to know more about me or what I do in my real day job, there's some links there for you as well.
Garth, thank you so much for being on This Week in Money.
Pleasure as always, Jim. Thank you.
My guest has been Garth Turner, investment advisor with Raymond James, and check out his popular blog, greaterfool.ca. Coming up, Zeal LLC CEO Adam Hamilton on This Week in Money.
GEM International is a new diamond explorer in the richest diamond producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. GEM International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Adam Hamilton, CEO of ZealLLC.com. He's speaking to us from Colorado. Welcome back to This Week in Money, Adam.
Hey, Jim. Great to see you.
Precious metals have had a pretty good run so far this year, considering their low last year. And we'd really like to take a look at silver, which I think, or perhaps you think, is ready for a nice little charge here.
Yeah, silver's been absolutely amazing, Jim. Back in mid-December, both gold and silver carved major secular lows, like around 6 years. I think 6.1 for gold, 6.4 for silver, if memory serves. And the reason was there was this massive, huge, crazy futures selling by American speculators on fears of a rate hike. And that first rate hike came and passed in mid-December, and the world didn't end. Interestingly, if you look at past Fed rate hike cycles, there's been 11 of them since 1971, and gold actually rallied on average through all of them. I think the average rally through all 11 was like around 30% for gold. And in the 6 of those 11 where gold actually went up, it rallied an average of 61% or so. And those happen to be the ones where gold entered the rate hike cycle near secular lows or relatively low in recent terms, and also when the rate hike cycles are gradual. Obviously, our rate hike cycle today, if you can even call it that, since we only had one rate hike and no more since, should be bullish for gold, and therefore silver as well. Naturally, silver follows gold. Silver leverages gold's upside. So silver and gold both bottomed heading into that rate hike, and after that rate hike, people realized the world wasn't ending, and that gold and silver could still catch a bid even in a rising rate environment. And the metals have been off to the races ever since. Silver got off to a slow start earlier this year, and that's actually pretty typical. If you look at past early up legs and early bull markets in gold and silver tends to lag gold a bit. It takes silver investors a while before they're confident enough to buy silver. Silver is super volatile, highly speculative, and when you're trading it in futures, the leverage is incredible. And so speculators and investors tend to wait a little bit. They want to see gold rally far enough and for long enough to make them believe that new gold up leg or bull market's the real deal before they buy silver. So silver lagged in January, February. It really started picking up in early April. We started to see investment buying hit silver. And since then, it declined in May again on rate hike fears, but it just rocketed higher at the end of June, which is really exciting.
Is it easier for the average person to invest in silver rather than gold?
That's a good question. Obviously, silver is cheaper per ounce, and that makes it easier for people to get the capital. If you have $1,000, you can buy multiple ounces of silver. If you have $1,000, you can't even buy 1 ounce of gold. So if you're buying physical, yes, it is easier to buy silver. Also, the preferred physical forms of silver, like the junk silver coins in the U.S., I think they're pre-1965, just general American coins that had silver in them. You can buy those in different quantities, and so, yeah, it's easier to buy silver from a unit standpoint, but most people buy gold and silver today electronically. The GLD and SLV ETFs are really popular. And if investors are doing it that way, moving stock market capital into gold or silver, it's really irrelevant. I mean, buying one ETF or the other is cheap, easy, trivial, efficient, and so I don't think silver is easier to buy for most investors. If you're going physical coins, yes, but the way most people do it today, not necessarily.
If you were buying, what would you pick, gold or silver right now?
I'd pick silver, Jim. Since those mid-December secular lows we discussed, as of the middle of this week, this past Wednesday, gold was up about 30% off those 6-year secular lows. Silver's up about 47% off those 6-year secular lows. Generally, in major bull markets in gold, silver tends to leverage gold's advance by 2 times to 3 times when investors get excited. So right now, silver's only at about 1.5 times gold's bull market advance so far, and it should be well up over 2 times. So silver has a lot of catch-up to do still. And so I think silver has way more upside potential in the near term than gold does, just because silver's behind gold at this early stage in the bull markets.
Is it a factor that silver's also an industrial metal? It's used because it's such a good conductor of electricity?
It's definitely a factor, but it's not really relevant for the silver price. The reason is silver industrial demand, while huge, is stable. It's relatively constant year after year after year. I mean, there's some new categories of silver demand, like for solar, to make solar power cells, and that's gradually growing. But for the most part, industrial demand is relatively constant regardless of silver price. Silver, because of its supreme conductivity, I think it has the highest conductivity of any metal, and the most ductile, and conducts heat the best of any metal as well. It's always going to be in demand in industrial applications, no matter how much it costs. I mean, if you have some kind of device like an iPhone that needs some silver, you don't care how much silver costs. I mean, it's such a small fraction of the device you're making, it doesn't matter. So industrial customers are always buying pretty much the same amount of silver. But the investment demand varies radically, and so that's where the silver price is set in the margin. So when investors want to come into silver in a big way, as they've done this year, especially in April and in the past couple of weeks and to the end of June, early July, silver's just going to rally dramatically because that investment demand varies so radically. So industrial demand is bigger, but investment demand is far more volatile, and so that's what drives the silver price to the margin.
I know that China has been snapping up all the gold they can find for the last 5 years. Have they expressed any interest in silver?
That's a good question. I don't know about any official interest, Jim. I haven't come across anything like that. They kind of reluctantly publish their gold reserves, and for 5 or 6 years there, going into last summer, they said they didn't accumulate any gold at all. Then they had this massive jump in their reported gold numbers. This is the Central Bank of China, the People's Bank of China. Interestingly, gold sold off hard in that because the amount of gold that the central bank reported accumulating over those past 5 years was far smaller than people thought. And some people, including me, thought, hey, the PBOC is just, they're not reporting all their holdings. They're reporting enough. They're going to gradually keep increasing them. That's what they ended up doing ever since. But I don't recall seeing central bank publications on silver, reports on silver. But one interesting thing is, silver was trading around 17 or 18 in late June, and that was even after the Brexit. The Brexit was June 24th. That Friday was the day when people figured out that the British people were going to vote to leave the EU to reclaim their sovereignty. And silver went from like 1725 the day before to 1775 the day after that. And it stayed around 1775 till the second to last trading day of June. And then silver all of a sudden shot up 3% out of the blue when gold was only up around 0.5%. And the only news that I found that day was there was kind of a short squeeze on Chinese silver futures markets. So Chinese buying could have very well been the catalyst that sparked this latest huge silver surge in late June and early July. So the Chinese people, the Chinese investors are definitely interested in it. I don't know about the Chinese government, although they do stockpile strategic metals for industrial use in case there's ever a war. So I assume they have substantial silver stockpiles there as well.
We'll have more with Adam Hamilton next on This Week in Money.
I'm Larry Ray, President and CEO of American Manganese Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm Jim Goddard. We're speaking with Adam Hamilton, CEO of ZealLLC.com. Adam, I know people should have a certain amount of gold in their portfolio, maybe more now than traditionally. Is that still the case as well with silver?
Absolutely, absolutely. You know, I think silver is really important to hold in the portfolio as well. Silver is more speculative than gold. It has higher upside potential than gold. I still think the basic core foundation should be gold. But, you know, silver's awesome to have. It could be in addition to that gold allocation. It could be part of that gold allocation. You know, silver is a really easy metal to fall in love with. Silver is almost a religion for some people, and I respect that. But, you know, it's important to be diversified in the portfolio as well. So I wouldn't recommend having your entire precious metals allocation in your portfolio in silver, but it could be a substantial amount. You know, say even up to half of like whatever you're allocating to precious metals in general. But yeah, silver is absolutely a very important part of any portfolio, just like gold is.
Are you surprised that people don't talk about it more?
Yeah, I am. You know, over the past few years, the stock markets were levitating because of what the Federal Reserve was doing here in the U.S., and people just didn't want anything to do with alternative investments anymore, and they're led by gold, and of course silver follows gold, and so gold and silver just fell just incredibly out of favor in recent years, and everybody hated them. And I think that's one of the reasons people didn't talk about it much. As part of my job as a newsletter writer and researcher and speculator, I have financial television on all day, every day. CNBC, Bloomberg. I start at 5 in the morning, you know, quit at 5 at night. So I'm always listening to what's going on in the media. I don't really care what the media is reporting so much. If I want to hear what the zeitgeist is, what they're saying, what they think, and so I can feed that as a contrarian. And we've seen a lot more interest in silver this year than anything I can remember in the previous years, especially in April and late June here. So silver is starting to get more discussion as it rises. You know, nothing begets interest in investing like rising prices. People want to chase winners. They want to play momentum. And so silver is starting to regain favor just by virtue of its incredible performance this year.
Is there an upside to silver because it's also a byproduct of so many mining processes?
I think around 70% of the silver mined globally is a byproduct. I don't have the exact number in front of me, but the Silver Institute, they do the best fundamental data on silver, supply and demand data globally, and their recent report just released, I think it was early May for 2015, they talked about like around 70% of global silver production being a byproduct. You know, whether that's bullish for silver or bearish, it kind of depends. You know, it could be bullish for silver in the sense that no matter how high the silver price rises, you're not going to open a new copper mine just to produce more silver, because that might be, you know, 5 or 10% or less of your revenues. So therefore, the 70% of silver production that's a byproduct, that's not going to be responsive to the silver price. And in addition, a lot of those base metals miners and even gold miners have sold their silver upside away. They sell their silver production to companies like Silver Wheaton, who buy it for incredibly cheap prices, like around $5 an ounce. And so with all their upside gone, since they sold it to silver streaming companies in return for upfront cash payments to help them finance their mines, these primary base metals miners or primary gold miners have no incentive whatsoever to expand silver production with rising silver prices. So silver production is really abnormally constrained compared to price, unlike gold production. Nevertheless, you know, it takes 10 or 15 years to permit and build a mine anyway. So even if these miners wanted to expand their silver production, they just can't for a decade or so because it's so onerous to go through the permitting process and get all the necessary permits, get your mine built and financed. And so silver supply is really unresponsive to silver price. I mean, silver could go to, you know, pick your crazy level for years on end, and it wouldn't affect the supply coming online for a decade or more. It's pretty awesome.
Adam, can you tell us a bit about Zeal LLC?
Yeah, Zeal LLC is my little company I founded about 16 years ago. I'm a private investor and speculator, and I figured I had to do all this research, so why not sell it in the form of inexpensive newsletters to help people out? We publish a weekly newsletter, a monthly newsletter. We've had subscribers in every state, 60 countries around the world. Just talks about the markets, what's going on, and what trades we're making based on those, and I think it could really help everybody out who's interested in learning about the markets from a contrarian perspective and making profitable real-world trades based on it.
Adam, thank you so much for speaking with This Week in Money.
Great talking with you, Jim. Have a great weekend.
My guest has been Adam Hamilton, CEO of ZealLLC.com. That wraps up our show for this week. We'd like to thank our guests, Ross Clark, Garth Turner, and Adam Hamilton. And thank you for listening. If you have any questions for the show, you can email info@howestreet.com. I'm Jim Goddard. We're back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen.